Picture this. You finally do the responsible thing. You start saving money. Every month you move a little into your savings account. $100 here, $200 there. You feel good about it. Responsible, disciplined, financially mature. But then one day you open your banking app and notice something strange. Your savings account has $10,000 sitting there, earning something like 0.5% in this illustration. So after a whole year, you have made about $50. Meanwhile, you keep hearing people talk about investing, stocks, index funds, compound growth. All of it involves risk and can lose value. And suddenly you start wondering, wait, am I doing this wrong? Because saving money is good, but saving alone rarely builds real wealth. This is where a lot of people get stuck. They know saving matters, but they have no idea how to go from saving to investing. So in this video, we will break down the exact step-by-step path to turn saving into investing, without feeling overwhelmed or risking your financial security. If you have money in savings, but are not sure how to start investing, stick around. This is educational, not financial advice. Follow at the 2 a.m. wallet. Let us start with something that might sound a little controversial. Saving money alone will almost never make you wealthy. Saving is important, but it is not the final goal. It is just the first stage. Here is the thing. Savings protect your money. Investments grow your money. Those are two very different jobs. And remember, investing always carries risk. Let's look at the math. Imagine you save $10,000 in a typical account at about 1% interest. After 1 year, you'd have $10,100. Savings rates vary by bank and over time. Now, over the long run, the broad stock market has historically averaged around 10% a year. That same $10,000 at 10% would be $11,000 after 1 year. That's a long-run historical average before inflation. Past performance doesn't guarantee future results, and investments can lose value. $900 in a year, that difference might not seem huge at first. But here's what most people don't realize. The real magic is compounding over time. After 20 years, that 1% grows to roughly $12,200. But at around 10%, it would be roughly $67,000. These are hypothetical fixed-rate illustrations to show compounding. Real returns vary year to year and can be negative. Honestly, one of the biggest wealth gaps is between people who only save and people who also invest. And a lot of folks never make that move. There's no shame in starting wherever you are. The point is just to understand the choice. Here's the thing. The reason most people stall isn't math. It's psychology. Saving feels safe. Investing feels risky. In a savings account, your money doesn't really move. It won't drop 5% on a random Tuesday. Investments do move, and in this illustration, that up and down, the volatility, is exactly what scares people off. Remember, investing carries risk and can lose value. And you might be thinking, I don't want to lose my savings. Totally fair. That worry is the whole point. That's exactly why the move from saving to investing should happen in stages, not all at once. Let's walk the path, one step at a time. Step 1. Build a real emergency fund. Before you invest a single dollar, the idea is to have 3 to 6 months of your expenses saved in cash. Boring, safe, and ready. This money is for life's unexpected problems. A job loss, a medical emergency, a surprise car repair. It's not for growing, it's for catching you. The biggest reason people panic sell is simple. They need the money too soon. A real emergency fund protects your investments from your life, so you're never forced to sell at the worst moment. Step 2. Separate your saving from your investing, mentally. This one's huge. Think of them as 2 different buckets. Your safety money doesn't move. It stays put. Your growth money is allowed to fluctuate because that's what lets it grow over time. Just remember, investing always carries risk. Values can go up and down, and nothing's guaranteed. And honestly, that one mental separation reduces the anxiety dramatically. Step 3. Start investing small. You don't need a fortune to begin. Many brokerage platforms let you open an account and start with just $50 or $100. And at the start, the goal isn't big profits, it's building the habit. Showing up steadily, month after month, matters far more than perfect timing. Step 4. Keep it simple at first. A lot of beginners feel like they have to jump straight into complicated strategies, and that's usually where it goes sideways. So early on, it's worth being cautious with the high-risk stuff. Day trading, options, crypto speculation. These can move fast and lose value just as fast. So for most beginners, they're better to watch than to wade into. One simple option people often talk about is an index fund. Instead of betting on a single company, an index fund tracks a whole market. So a single purchase can spread your money across hundreds of companies at once. That diversification spreads out risk and aims for steady long-term growth. It reduces risk. It doesn't erase it. A fund like this can still lose value. In fact, plenty of long-term investors have pointed the same way for years. For most everyday beginners, simple, low-cost index funds are a reasonable place to start learning. The most powerful strategy is actually pretty boring. It's called consistent investing. Small amounts, automatically, again and again. Imagine investing $300 a month at a fixed 8% a year. After 25 years, the math works out to roughly $285,000. This is a hypothetical illustration with a smooth fixed rate. Real returns vary and aren't guaranteed. In that example, you'd only have put in about $90,000 of your own dollars. The rest, nearly $195,000, comes from growth. That's compounding working in your favor. And again, it's illustrative, not a promise. But psychology still matters. Markets go down, the news gets dramatic, and people panic. The quiet discipline of staying invested is what separates long-term investors from gamblers. Here's an easy way to picture it. Saving money is like storing seeds in a jar. You're protecting them, which is good, but nothing grows. Investing is like planting those seeds in soil. It looks messy at first, and you can't see much happening. But over time, with patience, they can grow into something far bigger. Now you might be thinking, okay, but what if the market crashes? Here's the reframe. Market crashes are normal. They're part of investing. And for patient long-term investors, downturns can actually be an opportunity, though of course, there are no guarantees. When prices fall, your same monthly amount simply buys more shares at lower prices. So if markets recover over time, those cheaper shares can work in your favor. Again, illustrative, not a promise. This is why patient investors tend to stay calm. They think in decades, not days. Let's pull it together. Step 1. Build a 3 to 6 month emergency fund in cash first. Step 2. Keep your safety money separate from your growth money. Step 3. Invest small amounts consistently. Step 4. Many long-term investors lean towards simple, low-cost, diversified index funds. That's one common option to learn about, not a recommendation. And Step 5. Stay disciplined and let compounding do the slow, quiet work. Remember, all investing carries risk, and returns are never guaranteed. Here's the heart of it. Saving money gives you stability, a calm, protected base. Investing reaches for growth, and growth always comes with risk. The earlier you combine both, a protected base plus patient growth, the more room your future has to breathe. If any of this clicked for you, follow along at the 2 a.m. wallet. That's where the next small money lesson lands. So, are you saving, investing, or just starting both tonight? Tell me in the comments. That's the moment your money quietly starts working for you. This is educational, not financial advice. Do your own research before